Hi folks, I hope you're all doing well. My name is Amir, I'm a mortgage broker, and recently there's a new program that has been rolled out for first-time home buyers that I wanted to explain to you in hopes that if you were looking to buy a home and you were not able to because of the high interest rates today and or because you didn't have a down payment, this is very good news for you. So listen on. Yes, so the program is called Dream for All Shared Appreciation Loan, or the DFA loan. It's a very new, just came out end of March, very new and very exciting program for first-time home buyers, like I said. It's offered by CalHFA, that's the California Housing Finance Agency. It is there specifically designed to help low to moderate income Californians buy their first home. It helps first-time home buyers buy their first home. So how does it do that? We will explain that in the next slide. So what is it? Basically, it's a CalHFA, a California Housing Finance Agency conventional loan. CalHFA offers these conventional loans. This is nothing new, but this loan has three components. The first component is the first mortgage loan, which is the conventional loan. The second component is the DFA principal. That is the amount of down payment which the program will give you, which is up to 20%. And also then the DFA shared appreciation amount is a percentage of the equity gain that you are going to be owing to pay back for this DFA principal. That happens when something triggers, like you sell your home. I will explain more of that in the next slides. So what benefits does this program have? That is easy. These are the top three. It provides the first-time home buyer with a down payment up to 20%. So if you don't have down payment, no problem at all. Here you're getting your 20% down payment. It does offer the low to moderate income Californians a lower interest rate. So basically you are getting a lower interest rate. And also, if you take the 20% and you apply them all to the down payment, that means that you would only be owing 80%, and that means that you would require no mortgage insurance. So you would be saving on that big fee too. It's a big monthly fee. So this program is designed for two types of borrowers: the low income borrowers and the moderate income borrowers. Okay, but who are the low income borrowers? Basically anyone whose income is less than 80% of the area median income. That means the county that they live in. If their income is below 80% of the area median, then they qualify as a low income borrower. The next group is the moderate income borrowers. They are people that are first-time home buyers that their income is between 80 to 150% or the max of what the county limit allows. So anybody that has that their income is more than 80% of the area median and up to the maximum allowed, those are considered moderate income borrowers. What is the difference between two? We will explain more when it comes to actually getting the loan and paying it back. This is a chart I've provided for you. It's from CalHFA. Basically, it's a list the counties in California with all the maximum income limits per county. If you look, for example, at Santa Clara, you would see that the maximum is $300,000. There are also two loan limits that we need to consider. One of them is, of course, the conforming loan limit, okay, which has a ceiling of $726,200 in Santa Clara. But it is different for every county in California. You need to know what that loan limit for you is in the county that you are going to be purchasing your home. Also, there is the high balance loan limit, which has to be less than $1,089,300. Again, that is in Santa Clara. It is different in other counties. You need to verify that to see what is this limit for your county. So let's see how this works. First, for the low income borrowers, remember who they were? Less than 80% of the area median income, okay? So how does that work? Let's assume a good scenario that the first mortgage is going to be a conventional mortgage of 80%. That means that the home buyer is taking advantage of the maximum 20% down payment that is going to be given to him through this program, him or her, through this program. So here's what happens. We get a first mortgage for 80%. It's a regular mortgage, conventional. We have an interest on that. It is lower than the market, but there is still an interest. And there is a payment which we make on a monthly basis. Let's say this is a 30-year fixed loan, conventional loan. We have a payment to make every month that has a part principal and a part interest. Okay? So that's for the 80%, the first loan. The second one is the shared appreciation loan, okay, that has been given to us. It's the DFA loan. So what is that? That's a 20% maximum down payment. So in order for the buyer, the low-income borrower, to buy his place, he needs the first loan, which is 80%, and the 20%, which is the down payment or the appreciation, the shared appreciation loan. So on that 20%, there is no interest and there is no monthly payment. Okay? And so this is what makes this very interesting, because you take 20%, but you actually pay for 80%. Okay? So, and you have provided with your down payment. And then again, if you do apply all 20% to your down payment, then that means that your debt is not more than 80%, and that will save you mortgage insurance. So, how does this work? How do you pay it back? Where does the CalHFA make money out of this second deal? Is when you sell your house, or if you refinance with another company, there are some triggers that need to happen. When that trigger happens, selling a house is certainly a trigger. When that happens, then the government will share in the equity that you have gained on your house. So how much? 20% of that equity gain will belong to CalHFA, which I'm going to explain to you in an example. So here's an example. Okay, so John goes ahead and purchases a house for $500,000. Okay, and he uses this program to purchase his house. That means that the first component is a mortgage of, let's say, 80%, which is $400,000. And of course, John maximized the equity shared appreciation loan to 20%. So that is $100,000. It means John had a mortgage of $400,000 and then a second mortgage of $100,000. He was making monthly payment. He was paying interest for the $400,000, but the $100,000 had no interest and he was not making any payments towards it. So now, let's say after 5 years, John goes ahead and sells that house, right? And he sells it for $700K. So how much money did he make? What's the gain in the equity? The gain in the equity is $200,000. Because he is a low-income borrower, okay, he pays 15% equity. Okay, in that, he back to the CalHFA program, he pays 15% of the gain equity. So he gained 200,000. 15% of that 200,000 will be 30K or $30,000. So basically, John will pay back to the program the $100,000 that he borrowed first, plus the $30,000 in shared equity. So what is the balance of equity left for John? $170,000 will be John's gain. Let's now look at the next type of borrower. Here's another example. This is more graphic. Let's say again, it's same John, he's buying his house for $500K, and there is the $400,000 first mortgage. Here's the $100,000, which is the money that received as down payment, okay, which is a part of the program. And it comes to be that he sells his house after 5 years for $640,000. Remember, we were calculating $700,000 before, now it's $640,000. So what is the balance? He bought it for $500K, he sold it for $640K, so the balance gain or equity gain is $140,000. What is 15% of $140,000, which the low income borrower would need to pay back? that would be $21,000. So when the loan is closed, when the property is sold, the home buyer he was a low income borrower will pay back $21,000 in shared equity back to the program. I hope this is clear. You understand it very well. And if you have any questions, you can always reach out to me and I will explain it further for you. Let's go to the next type of borrower. So this is easy. The moderate income borrower, okay, basically the program, the deal is all the same as the low income borrower that I explained in previous slides, with only one difference, which is difference, which is instead of 15%, the moderate income borrowers will give back 20% of the gained equity in their property. So the difference is that the low income borrower pays back 15% of the gained equity, but the moderate income borrower will pay back 20%. So let's look at an example. So again, John buys a home for $500K through the program, same first mortgage 400, down payment 100,000, or that's of course also really the second mortgage on the house, DFA. Again, the same program. He doesn't pay on the $100,000 until he sells his house in the next 5 years. What happens? He sells it again for $700K, and the equity is still the same, $200,000 gain in equity, but then he pays 20% of that, which is $40,000 back to the program. That means he pays 140, the 100,000 that he received first, plus the 40,000 in shared equity. So you see the difference between moderate income and low income in this same case is $10,000. A low income will pay $10,000 less in this same situation than the moderate borrower. So this is one of the biggest differences. Again, looking at a second example, same as the first one that we saw for the low income. For the moderate, the example here is the same, $500,000 purchase price, but the sell price was $640,000. So here the equity gained is $140,000, but because the moderate income pays 20%, that is $28,000 that this needs to pay back into the program once the house is sold. So you see the difference. The low income borrower paid $21,000. The moderate income is paying back $28,000. So take these differences into consideration. So what is the eligibility criteria? You need to be a first-time home buyer. What is the definition of that? It means that you have not owned a home for the last 3 years. Okay, so that is the definition. If you had a home 5 years ago, 4 years ago, that's fine. You still, and you don't own one now for the last 3 years, you're a first-time home buyer. You need to have a minimum credit score, of course, and debt to income ratio, or DTI. It depends on your FICO, that how much your DTI would be. But let's say with a FICO score between 680 to just under 700, it's 45%, and your DTI ratio can go up to 50% if your FICO score is more than 700. Now, if you are a low income borrower, okay, that means your income is below 80% of your county median, right? So then you could qualify for a 45% DTI, the 660 FICO score and up. Okay, so this program covers the types such as single family homes, the condos, and the manufactured homes. It has a maximum TV of 105% and a minimum of 70%. If you need to know what those are, get in touch with me. I will explain those to you in more detail. You will also require to take a CalHFA first-time homebuyer education. I believe it costs around $99. That is required. You need to make sure that the house, the property that you're purchasing, is covered by warranty, a home warranty for at least 1 year. And also, this is not just, this comes together. I told you it's a 3-component loan. All 3 components need to be there, so it has to come with the first conventional loan, which I explained in the examples. So, I hope that now you have a good understanding of what this program is all about. It is a really good program. I've evaluated from many different aspects, from different sides, and it's a really good program. gives you 20% down payment. And if you sell your house after 5 years, let's say, and you make absolutely no equity, let's say you buy it for 500,000 and you sell it for 500,000, you basically return the government's money without paying any interest because you didn't have any equity. So you basically use the money for free. But again, if there is equity, which is good to have equity, I hope whatever you buy, it multiplies in price. Okay, and that means that basically you have a biggest chunk of that equity for yourself, and while you didn't have a down payment, you were able to buy a house and to put so much down payment down that you didn't even need to have mortgage insurance, which by itself is a few $100s, depending on where you get it and how good your credit is. So if you need more information, let me know. Okay, I could really help you figure this out. If you require to see if you qualify for this, again, give me a call. My name is Amir. Phone number is 408-309-9933. My first mission is to educate you. Second is to do business together if you like what you see. So, okay, in that case, let us hope that this program will go on forever. But from what I have heard is that it is limited for this year to the fund. I believe it can serve maybe 2,000 people, but there's a promise that we will have more funding next year. So if you're interested, get on this as soon as you can, get on the bandwagon, because we don't want to the program run out of funds, and when you're ready you don't have the funds. So get in touch with me. Have a great day, guys. Bye bye.